Hello, everyone. Welcome to our first podcast. My name is Matthew. This is Joshua. Together, we're casual folks having a casual conversation. Hope you enjoy.
Yeah, so we just wanted to give you guys a little introduction to this video. It was pretty much a freestyle conversation between myself, Matt, and Riyadh. We had a lot of fun. It bounced around a lot. We hope you keep up. If you have any questions, you could just let us know. We hope you enjoy.
So you said you think you can time the market. Obviously, you can't. You think you potentially know where you would like to enter? Yes or no?
After it corrects, yeah.
But okay, good. Now, when you say when it corrects, where's it correcting to? 20%, 40% correction, 60% correction? Where is it? That's what I'm asking you.
20 to 40, basically.
That's okay. Okay, excellent. Excellent. What do you think is going to cause it to get into to your sweet spot? What factors need to happen in order to push the market correction into that sweet spot zone?
And when you also have a question to follow up when you finish answering.
First, well, obviously they already said Fed said no interest, so that was one. But if they said they're not going to raise the interest rate on the Fed level, so no, that's not going to happen this year.
Okay.
My second thing was when the eviction starts, you're going to see a job loss increase because of that eviction. We're going to have more homeless.
Okay.
But the other thing is if the stock market doesn't follow the real economy, and eviction is part of that, we have a housing bubble that's happening.
Mm-hmm.
That's also that might trigger more of a debt crisis.
Mm-hmm.
We also have a global debt crisis.
Okay.
All of that could take part. And I'm also looking at China too, seeing what's happening on their stock market because, and the second one is England. I always say whatever happens in Europe happens here next. So if I see a trend in England and Europe, it's going to happen here.
Excellent.
Yeah. Now, okay, all of those things are very valid points. And, there's possibilities that those outcomes could happen and be the catalyst. One could be the catalyst that causes this correction that you're talking about.
Yep.
Do you think it's impossible that the market could go up 40, 60% from here and then correct 20, 30%? And then would you think that that's cheap at that time, even though it would be 10 to 15% higher than where it is now?
There is no guarantee, but it would still be cheap now than then. But how would you know that
exactly
it will go
exactly
up?
That's the question.
But how exactly?
So then
you don't know.
So time in the market, being there now.
No, being here now is too high. I would never do that.
But then what if it goes up to 60,000? What if the Dow goes to 60,000 and then the Dow corrects 40%?
That's the risk you were willing to take.
Yeah,
I am not.
Yeah. Okay.
Yeah, but how is that a risk I'm willing to take? I've been in the market the whole time.
All right.
So exactly. If you're now not in the market and you understand this, why would I take the risk? That's what my thing is.
Okay, because markets don't just go up.
All right. Can we mathematically do something really quick? Can we mathematically do something?
Mm-hmm.
All right. And risk management right now. Let's take, what's your favorite company?
Just pick Apple for now.
Dope. Apple. Let's do some simple math.
Mm-hmm.
Apple's $100.
Why everyone says that?
Right? Apple's $100. Right? You're expecting this correction. Right? You're expecting this correction.
Mm-hmm.
Right? What would be the ideal price with your correction that you want to buy Apple?
If it's at 100 now?
Yeah, 100 now. You're thinking this is too expensive. Right?
Same 20% correction. So
$80, right? Mm-hmm. Good. So you're going to wait at 80, right? You're going to wait till it goes to 80 to buy. And you're not buying before, right?
No.
Okay, good. What happens now if it goes to $80.50 and never hits 80 and it runs out?
It doesn't have to be exactly.
That's what I just asked. Okay, good. So
close to 80.
Close to 80, right? We'll give you a $2 hit, right? Boom, right? Now, let's talk, it goes to that price that you wanted to go to, right? Mm-hmm. Hypothetically, how much would you have bought there? Let's say you bought 100 shares.
Yeah, $800.
Right?
8,000.
100 shares. 100 times 80 is what?
$8,000.
Sorry, excuse me. Right? Now, you have 100 shares.
Would you buy $8,000 in a company? Let's say hypothetically, the stock collapsed 40% to $82.
Mm-hmm.
You just saw that collapse from wherever it was 40% higher to $82. You would put $8,000 into Apple at that point.
but not right away when it dropped, not like the day of.
So what happens if the next day it goes
drops
from
it.
82 to 100?
Yeah, that's my point.
That's a risk you got to take.
Would
But
you
now-
buy
but
it at
hold on, time
100?
out.
Would you buy it at 100?
No, I won't buy it back.
But hear me out though.
So then you'll stay out of the market.
But hear me out. You're staying out. What I'm trying to show you is, you see how you said you wouldn't have gotten in, right? My point is, I'm trying to show you the difference of the money you would have saved doing it the way you want to do, right? And back to the $8,000. You just spent $8,000, right? You're like, yes, I got my $8,000 in, right? But what if Apple never came to that buying price? And let's say it went to 85, 87 from 100, right? 90. You're looking at a $10 difference times 100 is $1,000, right? Of your loss. So that is what you're really going to lose if you're wrong.
Also, what if it drops to 82? You buy $8,000 worth of it and it falls to 70. What would you do then?
You just got to hold it.
Yeah, exactly. So then that is
It's
the
not
same.
going to sell.
No, absolutely.
Okay, so why do you have an issue with me holding it to 60,000?
Exactly.
Down to 60 and then it falling from 60 to
No, I'm saying
40.
I'm not going to jump into that. You already in time in the market. You're telling me time in the market, XYZ. I'm telling you, no, I choose when to jump into the market, not because you said time in the market. And because if I list all of these on a macro level, you tell me it's valid, and then tell me at the same time, jump into the market because you don't know what's going to do next. You're basically betting against him, you and the hedge funds. You're not betting against anything fundamental at this point.
Okay, excellent.
So I don't understand that logic.
Absolutely am.
So it's a flawed logic to me.
So the things
for somebody who's not in the stock market, you guys trying to convince me to do that.
No, but you
or at least help me to get into
when you
understanding
say fundamental, I
what are you guys using to know when it's going up and going down? Nothing, right?
Yeah, of course.
Yeah, of course. You have
what
to
are
base
you
it
using?
on something.
Okay, you're telling me the what ifs. What if Apple goes to 100? What if it drops to 80? What causes that?
That was our first question here, right? What's going to cause our 20-30% correction?
If there is no economic collapse, none of this happens and it still corrects down.
Yes.
What was that cause?
The bond yield, my friend. This is what I'm trying to get to you. The bond yield, these are numbers now. These aren't hypotheticals. Bond yields are moving up. Inflation is going up.
I see that.
Right? That's what's going to cause it. 0% interest rate makes markets go up. When money is cheap to borrow,
it's cheap.
Everyone's lucrative to go buy, lose, bankruptcy. Let's go get another loan.
Yep.
Boom. Right? The bond yield is what's scaring everyone right now. Everyone expects inflation to go over 2%.
Yes.
So that means bond yields are going to go above 2%. Everyone was thinking 1.7 to 2. But if inflation is going to go above 2, bond yields have to go above 2. Right? That is what the real scare is right now in the market. Right? That is what the real big scare, I feel, is in the market. That's going to cause this correction of the snowball. Did you guys just see what just happened with Tiger Global?
No.
Okay, this is huge. Tiger Global, it was wild. Hedge fund went to bank. They're known. They've made money. They borrowed a few billions of dollars and then took it and put it on a multiplier.
With the CEO that was borrowing money from every single bank.
Yes. And then
putting it on the same security.
Yes. And just kept multiplying and building up and inflating.
It was a huge flaw in the system.
Boom. Things like that is what you need to be aware of.
Those are black swan situations.
Yes, but this was a huge black swan. That also caused a lot of fear. Because now what happens is this could have all happened with no one noticing anything if everyone did their part. They needed to sell shares to liquidate to get back into position, to have the money, right? Because of margin call. But if smaller case numbers, if you sold 20 and he bought the 20 from you and then he sells the 20 to me and then you buy it back, the market wouldn't collapse. But no one wanted to be bag holders. None of the banks wanted to be bag holders, so they dumped.
They all dumped.
And then that caused that trickling effect. And now that with what's going on with how people feel about economy reopening, the housing bubble isn't going anywhere. It's only going to get bigger because interest rate is so low.
I don't mean to interrupt, Riyadh, but everything that he's saying is to summarize it, the things that you know, the things that are visible are not the things that are going to cause the collapse.
Yes.
It's the things that are unknown. Everything that you know, everything that you're seeing is factored into every stock price
already.
Every equity, every security, every real estate price, everything already, because that's how markets run. This is how markets run. That's the efficient market. hypothesis. It says that all the information that is known is already factored into those securities. The only way you can pull profit, you can make a profit out of those things, are to use these little techniques that we use: technical analysis, fundamental analysis, extract that information and hope that not everyone is identifying the things that you're identifying, because that's how you make money. When you know something that not everyone else knows.
You guys ready to laugh for this?
What?
Uranium is going to blow up even more, literally. You don't think so?
No, I don't like the idea that it. What do you mean, like explode in stock price?
Yeah, uranium.
Why? Because Iran is enriching uranium.
Not only that, it's not only that. That's part of it, though. That's part of it. Uranium's clean energy. It's a better
nuclear energy.
Yes,
I know.
And everyone's gonna go carbon zero, right?
Yes.
Zero carbon. EVs are being massively adopted.
Yeah.
What are you gonna hear about to charge these guys, right? Nuclear will be able to do that.
I understand nuclear. I've been saying that. The cleanest energy out there has been nuclear.
I've been loading up and I've been pushing nuclear stocks.
That was one of my first things.
So hard.
And energy.
So
it was nuclear.
What companies have you chosen, and why have you chosen them in the nuclear energy field?
Well, I choose the mining companies first,
Okay.
Right? I look at the mining companies. It's like, during the gold rush, it's the people that also sold shovels and barrels, and wheelbarrows that made money as well too, right?
Yes, right.
So it's like, let's go look at the people that transport the uranium or transport hazardous material like that.
Yes.
With infrastructure coming up and with Biden's EV push and all that stuff, they're gonna need the uranium.
Correct.
I got a little tip for you on top of that.
What?
Because you always giving me tips.
Yeah.
I give you a little tip.
Yeah, 100%.
So
call or put. That's all I want to know. An expiration date.
Call and write it to 100. Do whatever you want.
Which one?
So on the topic of precious metals and energy and stuff like that. I love gold. I love silver, but it's super inefficient.
Yeah, 100%.
You either got to buy the physical thing, hold it in your house, with the risk of being robbed, or you
buy it,
you put it in a safe that's away from your house, but you got to pay to store it. So it's super inefficient. I actually was able to research and find some really good royalty companies that are well capitalized, well funded, and are at the top of their game in the gold and silver mining industry.
Okay.
So these companies don't actually mine. What they do is they take your investments and they allocate the money that you give them into the mines that they think will perform the best.
Gotcha.
And then they collect royalties
from that. No, that makes sense.
And then they pay it out to you. So you get paid to hold.
I need those.
Yep.
I need those.
I mean, if anyone on the podcast wants us to drop name drop stocks and stuff like that, I'm more than welcome to share. But for now, when we get off, we'll talk about it.
What nuclear companies?
I'm looking at UEC and quadruple U's. They're cheaper. There's a potential lot more upside for it, and that was what I was looking at for it for those.
Okay, so my counter to that is that even though I like nuclear, how do you know that based on the political tension that we're in now that it's going to go through?
Because of the plants is important.
No, like go through. Okay, UMC. I'm not familiar with those companies. Is it American or is it outside?
American.
Good. How are you so sure that with the geopolitical tensions it's going to go through, because they don't want nuclear to be enriched in certain areas? I know it's in America, but that uranium still has to come from somewhere.
100%. But remember, it's like think about anything that's illegal, right? It didn't start out illegal in its
correct
baby form. You had to nurture it and turn it into whatever it is, right? To become illegal. Let's say, so bringing the raw material and bringing it to where it's all technicalities.
Exactly.
I think it also has to do with value. So before, uranium was used to make bombs.
No, it was used for energy. Then
no. I mean, like the
main function
that we all know of.
The value that they extracted from it was not energy producing energy. It was because obviously for political reasons and power, oil was chosen over
nuclear,
uranium.
yes.
But they were building predominantly bombs. That's what what
Yes.
it was being used for.
That's what the Cold War was. Yeah.
Right. That there's going to be a shift in value from war to energy, to a more to
I
a
agree.
cleaner
No, I agree.
earth, because there's a generational shift.
I agree, but there's also a generational pushback.
Yeah, you'll get that, but
So,
the younger generation is going to push harder.
Yeah, because what happens is
They're being phased out. You're always going to get that retaliation.
from the older, I understand.
But we're not going to put our money, which is our energy, our value, into the companies that these
are out the door.
Right.
Got it.
That are out the door, almost out the door.
Right.
I understand. Oil, almost out the
Well,
door.
it's not that oil is not going to be out the door. Hear me out. Oil is still going to be good. It's just automobiles for now. There's no ships yet. There's no EV ships. There's no EV planes, right?
You're working on the hydrogen.
There's
plane.
a transition.
Yeah.
Okay, this is the transition.
Are you
area
going to
that
invest
we're
in
in.
the one that's being phased out,
No,
or are you going to
hell no.
invest in the one that's being
Exactly.
phased in?
I would like to do nuclear, but I'm worried about the tensions that these countries would not allow it.
Okay, but then here's the thing, though. Just back to your Apple scenario, right? Right? Why, when Apple falls 20-30%, right? How do we, hypothetically, if it wasn't political, like what made Apple fall and what made you feel confident, like, okay, it can't fall anymore. This is the time. Because most people would be like, oh no, this is falling. I don't want to deal with this, right? Some people don't try to catch the bottom. They wait for the bottom to form, establish itself, and then they get confirmation that it's going back up and then buy. That is another form.
There is what it's called catching a falling knife, because you don't know if you're going to catch the blade or you're going to catch the handle.
So
weird ass terminology.
No, it is.
It is.
It's some weird ass terminology.
But now this is what I just
you're going to get hurt if you grab the blade.
But this is why some people wait for the confirmation. For example, you want to buy at 80, right? Let it go to 80, right? And let it go back up to 82, and then you buy.
Yeah. See if the floor falls out. Whatever is telling you that, hey, 80 is my safety zone. This is where I want it to fall. That's my base. You let it hit your base
and then go back up.
And then jump
because you don't know
how much is up.
Your base.
What is
that's your risk? That's your risk appetite.
That's your risk appetite.
Where you get the confirmation. For example, if it hits 80 and then it goes to 80, 25, that's not a real. They can come right back down.
Yeah.
But if it goes back to, like, for example, the trend lines, your Fibonacci,
your discount cash flow model.
Sounds very technical. Just
but this is what I'm saying. It's not easy what he does.
Yeah.
It's not. I'm way easier, but it's not easy what he does.
Yeah, because the way he told me, you just look at just for investing.
Well, I would
on
look
a
at
whole
the discount cash flow model. I would have to do that. I would have to set up. I'd have to calculate. Okay, so there's something called. So he was talking about it. He was talking about the bond yield, right?
That's not something
and interest
I
rates.
look at.
You have to.
How can you?
You have to discount that from the stock.
Yeah, 100%.
You can't, because remember, you're okay. What's the safest thing you could
purchase? Before you told me all of that was baked into the stock. Now you're telling me I have to discount it.
It has to be
because it hasn't changed yet.
Yeah.
So it's not baked in.
No, it is.
It
is.
Net,
but now you're creating a model for yourself. Now you're looking at the stock and you're saying, okay, what would be the perfect scenario for me to enter the stock? Because clearly it's too expensive for me right now.
Yes.
And I looked at the company. It's a great company, but shit happens. Things happen. Something might change. Maybe the interest rates go up, and that creates a shift. People run out of these big growth companies that are overvalued, because who's going to sit down and tell you that Apple is not overvalued right now? Nobody could tell you that Apple's not.
They still say
not even the bullish people on Apple
they
will
still
tell
say
you it's overvalued.
That was weird.
But it is, but it is. But where else are you going to allocate your money?
Yeah,
that's going to give you a better yield than what Apple gives you.
Not a lot.
Not a lot. So 0% interest. That you have to factor that into the cost basis that you're willing to risk on a particular investment. So that's what you're discounting. So now you're gonna put that in. Then you're gonna stretch out the earnings over a 10-year period. and you're gonna do your calculations. There's a special way to do it. We could do a whole podcast on just DA alone.
Back to the bond yield.
Not make it too technical.
Back to the
Right,
bond.
it'll make it too technical.
No, back to the bond yield on a technical level. That's not very technical. Every time the bond yield jumped, and you look at SPY, that's the S&P, right? Or you look at QQQ, which is the Nasdaq, right? The two indices that monitor S&P and the Nasdaq, right? Every time the bond yield raises, right? If it was already priced in, that means a couple of days before we should have seen a massive dip, correct? If you look at charts and you see the day that they've actually released it to the news that the bond yield is out, you see the dip. It's not the day before.
We see what he's talking about is reactionary. What I'm telling you is, if you're going to do a discount cash flow model, you're going to factor all of that in. You already know what your interest rates are. You already know what the current price of the stock is. And you already know how much you will give yourself in terms of a margin of safety. Because when you're investing as a value investor, you're giving yourself a margin of safety. That can all be calculated in for you to estimate what the price you're willing to pay would be. You understand what I'm saying?
Yeah.
I mean, without showing you my spreadsheet, you wouldn't understand it. But actually, you would. How am I explaining it as bad?
It makes sense.
It makes straightforward.
It's just you actually have to see these physical numbers, though. It's
Yeah.
like a lot of bookkeeping, and there's terms that you have to remember. This number equates to this, that to that. Once you physically
change one number, once you change that interest rate, it affects the entire thing.
So interest rates so that's another thing too. When bond yields go up, right? The Feds are going to have to counter at some point, right? What do you think? How do they counter that? They're going to have to raise the interest rate. And once interest rate goes up, that's when shit really hits the fan. It's not the bond yield, but it's a trickling of
the bond yield
indicator. You're telling me?
The bond yield is indicating that investors feel like inflation is coming.
Okay,
we're going to have a certain percent of inflation, so the yields are going to go up, the par values are going to drop because those two things work in an inverse, and then the Fed is going to look at that as, okay, people are expecting inflation, so then investors are going to say, well, if inflation is coming based on the bond yields,
then
the Fed is probably going to raise rates. And if the Fed raise rates, now growth stocks become
the thing.
No, they're going to become the thing that's going to get hurt, because now in an environment of higher rates, growth falls.
Yeah,
because growth is based on debt.
Yes.
When debt is free, your growth trajectory is out the roof. Who can go borrow money right now? Everybody could go borrow money at close to zero interest rates.
Yeah.
So if you have no headwind where that's concerned, then your growth is through the roof.
Okay, so all right. Before you told me that, when I was explaining the macro stuff, you told me these are stuff that it's public, right?
Yeah.
So is the bond market.
Yeah, 100%.
So if you're saying
the bond market,
just look at
just
that,
think of it as a predictive,
that's an indicator,
a predictive
like red light turn on, interest is gonna come.
Yeah.
Boom.
Kind of like how they say the inverted yield normally indicates that the market will experience a downturn, because a number of times in the past it's happened, but the last time it happened, we didn't have that because we printed a shit ton of money.
Stimulus.
Exactly.
And then we have to make up the deficit as well. We owe this money.
We owe it to ourselves.
Exactly. So that yields are going up. That's what's going to make the market pull back, because
those are going to be the things that are going to affect, and that's how you measure your risk. Those are the things you're looking at to measure, well, is this a time that I should go take huge amounts of risks, use margin, do options calls, do all these things, leverage myself out so that I can make as much money as possible. I think it was JP Morgan Chase that said, if you want to get rich, you got to use leverage. So but you got to do that when the time is right. You can't do that when interest rates are at 7%.
You gotta do it now.
Right, because if the stock market returns 10% on average, and then you're paying 7%, then you're making 3% after.
Mm-hmm.
And then you got to factor in taxes and all those things too. So all those things is what creates your risk environment. And and that's how you know how much appetite you have for risk. And that's how you weigh one investment over another in every environment. Because if you're making 7% sitting in cash, why would you take the risk to go in?
Maybe make 10.
Maybe.
Yeah.
Right?
Makes sense.
That's why the bond yields are so important.
Yeah.
The bond yields are super duper important. Because
where do you go to see such a thing?
You can look that up. That's a quick Google search. What's the 10-year yield on Bloomberg Terminal, CNBC, all these guys, they show you what the 10-year is, the 5-year yield is, and the 2-year yield. The 10-year is a real indicator though. It's like a real solid indicator of what you should look at.
Yeah.
Cool.
So
Go ahead.
I was trying to think. Hold on. So it seems as though it's way more complicated than basic, because all right, you guys are explaining it to somebody who's not familiar, right?
Yeah, 100%.
So you can then say not really when I'm telling you it is.
Okay,
from
so
a point of view
what's complicated
of not understanding, calculating that risk assessment.
The risk assessment is just a part of it.
I know that's one part of it,
but there's look, forget about markets. Let's talk about decision making. This is just a decision making thing, right? These are the criteria that we use for our decision making. Forget markets, decision making. If there's 10 things that needs to happen in order for you to buy something, or 10 things need to happen in order for you to go to this movie, or for you to make a decision, or you need 5 things to check out. Once those 5 things check out, you're good, right? This is all this is. This is not about his way or my way. This is about you figuring out what your criteria are. Let's say you have 20 or 3, and 3 checks out, and then you lost on that trade or you lost on that investment. Either you add criteria or you delete criteria, right? The losing part is important, because now you get to try to perfect your criteria to know when to enter and when to leave.
Okay.
So it's not complicated if you don't make it complicated, right? It's as simple as, what are my criteria? What boxes need to be checked, right? And if they check, then it's time for you to act. And if you don't act, then either your criteria aren't together, or you're just full of shit, right? Or you can sit on the side, watch, see how it plays out, and then be ready for the next move.
And don't complain.
I could have made this.
Yeah. I could have done this. I could have done that.
But then when the next time comes,
exactly,
that's why time in the market is better than timing the market. Right. Even though you didn't pull a trade, by physically seeing, okay, all 5 or 7, 10 or 3 of my criteria fit, hypothetically, I would have pulled the trade. Let me watch this for a couple of days. Did my 3 criteria that I chose to enter this trade, would this have made me money? And if it did, the next time your 3 or 5 or 7 criteria hit, you get in.
The other thing I would say, just to simplify that, is who are the people that make it in this world? It's the doers.
100%.
So it's either you're doing it, and sometimes it goes good, sometimes it goes bad. All these things that we're talking about is just ways that we rationalize
our decision making.
Doing it. That's how we rationalize doing it, because we do it. We got to do it. I can't not do it. We're doers. You know, if you're a doer, you got to do it. It's just what are you using to rationalize getting it done? What is it that's stopping you, and what are you doing to fix that problem? And once you figure that out, then you'll get it done. Then you'll know, well, okay, I want to do it Riyadh's way and use technical analysis, use Bollinger Bands, RSIs, and all these other technical analysis voodoos. Or you could do it my way, and occasionally read 10Ks in companies you're interested in. Look at how those companies are what they're doing, what they're actually doing. Don't look at the stock. Don't look at the ticker. The ticker means
Nothing.
nothing. It's just
I
a
know.
number that represents what the market thinks about this stock.
Yes, the same thing Buffett said.
Right.
It's like he would not look at a ticker; he would look at the company itself.
Look
Yeah,
at the
100%.
underlying
Check out
asset.
how. Thank you for tuning into our podcast. Look forward for more content coming soon. Enjoy, guys.
Bye.
Bye.